Welcome Pieter Slegers, one of the world's most followed voices in investing and the founder of Compounding Quality.
Compounding Quality, and it's at Q Compounding for the X, and it's compoundingquality.net.
Exactly.
What was it that gave you the confidence to quit your job?
I only quit my job when I knew that I'd make at least.
I'd love to get your thoughts on what you see for investors and investing staying the same or changing in the years ahead, especially now with the rise of AI and technology.
What I think is personally, I think the next decade for investors will be not as good as the past decade for investors. We know that the growth of working population is decreasing in almost all countries. So all the growth over the next decade needs to come from productivity growth. I would not be surprised if, for example, it would be a bit lower, 5 to 6% in the next decade. I'm truly a fan of the Capital Alliance community. So hopefully in the future, I can see some people who are listening there right now as well in the community.
Hi everyone, welcome to another episode of our Capital Alliance podcast. Vatsal, do you want to introduce our guest?
Yeah, thank you, Ken. Peter, I think, needs no introduction in the investment community. He runs arguably one of the most subscribed to and large scale research newsletters in the industry called Compounding Quality. Many people have benefited from the fact that he's democratized access to investing knowledge for so many people, and he's just added a lot of value for not just retail investors, but even for professional fund managers. I had the pleasure of meeting Pieter for the first time about 2 years ago in Omaha, and we again bumped into each other this time. And it's really a pleasure to have you, Pieter, with us. So thank you for doing this.
Thanks for having me, Ken, and thanks for the beautiful introduction, Vatsal. It's an honor to be here, and it's funny because we saw each other in Omaha 2 months ago, something like that, and now we are sitting together again. So it's a very small world in the investment world. So let's have some fun over the next hour.
Yeah, and Peter, I think one of the things that impressed me most, I met you, I think a year ago in Omaha, but I already knew about your newsletter because of your presence online, on LinkedIn, etc. And so I'd love to first, why don't you start with a little bit of personal background, what you did before publishing your newsletter and how you got into investing and deciding that you're going to go the publishing route instead of some other aspect of investing.
Yeah, sure. So my name is Peter. I live in Belgium, near Antwerp right now, and I've always lived in Belgium. Probably like many of you, my journey started quite early because I was interested in stocks quite early. So I started investing at the age of 13, just because when I was a little kid, I never understood how you could invest some money in a stock and it could increase in value. And to me, as a small kid, that sounded like you earn money without having to work for it. And that was exactly what I wanted to do. So that's how I got into investing in the first place. And obviously, in hindsight, well, investing is very hard work. We all know that. But what happened to me is, well, when I was about to turn 14, I was doing some work to earn some money, and I was storing shelves in the local supermarket. What I needed to do for an entire week is fill all the wine bottles into the store shelves, which is probably in hindsight also quite uncommon to let a 13-year-old person do that. I don't think you can do that anymore nowadays. But anyway, and one day I came back after my lunch, and the cleaning team was taking all the wine bottles out of the shelves to clean the shelves itself. And I had something like, what am I doing here? And I have a lot of respect for people who do those kind of jobs, but I really didn't like it. And it made me afraid about if I won't like my job and I need to do it for 40 years or even longer, well, that won't be the most fun time. And that's how I got into investing and in doing something, putting some money into it without having to work on it, quote unquote. And I made my first investment back then with all the money I earned. And it was a horrible investment for me. So I think I put all my money in one stock, made all the mistakes you possibly could. No diversification, didn't understand the company myself, just followed an analyst, and so on and so on. And I sold that stock with a loss of 60%, 60% after 1 year. But I think that's the best thing that could have ever happened to me, because that was very painful. But it also shows you when something like that happens to you, you can do two things. The first thing you can do is say, look, investing is nothing for me and I give up. And the second thing, that's what happened to me. It caused me to say to myself, look, I never want to make the same mistake again. And I really am going to read about investing, read as many books as I can, read the financial newspapers and so on. So that's how things started for me. And then, well, when I was about to go to university, I also needed to make a decision, because as a kid, I also always wanted to become a teacher, but I also had a passion for investing. So I was in doubt, should I go the teaching route or should I go for investing? So I chose the investment route, and I did a local version of an MBA in Belgium. And while I was doing that, I was also always working as a student. So I worked for some brokerage houses, I worked for some investment magazines, and so on. So when I graduated in financial management at the local university in Antwerp, well, I joined an asset management company. I joined the asset management company, was called Econopolis, which is probably a difficult name for English native speakers. But it was an asset manager based in Antwerp. We were a very little team, 20 people, and we managed more or less 3 billion. And I'm very happy in hindsight that I picked after my studies for a very small asset manager, because when you join, just saying something, JP Morgan, Goldman Sachs, you start at the bottom and then you need to climb the corporate ladder, right? And the luck I had probably is because the team was so small, you have the opportunity to right from the start sit next to someone who is, well, so the senior fund manager and so on. And everyone was drowning in work. And after 1 year, well, the opportunity came for me, and we were about to launch a new equity fund. It was a climate equity fund, so green, long only equity fund. And I, well, helped managing or doing the daily management of that fund. But for myself, I probably wasn't a huge believer of all the green stocks like hydrogen and what have you. I was quite skeptical, and I always wanted to work for myself. As a student, I was still working for investment magazines, giving some lectures about investing because I still have to teach. And then all of a sudden, well, he didn't mention it that way, but that was the message. My former employer, he came to me and he said, "Well, Peter, just focus on the fund you are involved in. Just focus on the climate stocks, and for the rest, please shut up." That was the message, and I was a bit stubborn, and that's what resulted me in creating compounding quality on social media initially, just to be able to say what I want to say whenever I wanted to say. Today we are here, so that's a bit how my journey from the start as a kid started, I guess.
So we're recording this in the middle of 2025. What year was that you first thought, oh, I'll just start compounding quality?
Yeah, it's the power of social media. So I started the in June 2022. I started compounding quality, but completely for free, completely anonymous, just to have fun. So that's what happened. And then the name compounding quality. So it just tells what you want to do. Compounding on one hand, so the magic of compound interest, and then quality on the other hand. So by investing in quality stocks. And then I wrote for free for 1 year, because given my contract, there was a strong regulation. Look, you can't have any side pockets. In other
Mhm.
words, I couldn't make any money outside of the job I was having. So I did it completely for free. And then in the summer of 2023, well, I decided to quit my job and go all in or work full time on compounding quality. So initially, I wrote very general stuff.
Hmm.
Like how to analyze a balance sheet, what is in the portfolio of Warren Buffett, just saying something. And then when I quit my job, well, it went deeper, like giving an insight to your personal investment portfolio, sharing investment cases, and so on.
Hmm.
And in hindsight, because I know a lot of people who will be listening will probably also be interested in the business related stuff.
Hmm.
In hindsight, I think it was a great gift that I had the no side pocket policy in my contract, because it was very hard work. I still worked 60 hours for my regular job and then probably 20, 30 hours for compounding quality. But
Mm.
because you are giving away everything for free, it's like a flywheel effect, as, for example, what Amazon has been doing. You're giving away all this stuff for free. People notice that you are putting in a lot of and that, and everyone who's listening knows the power of compound interest. But there is also such thing as compounding goodwill. And because you give to people without expecting anything in return, well, that costs you to indeed to keep growing from the newsletter perspective. So I think today there are almost 500,000 email subscribers. So it's 480,000 email subscribers, which is ridiculous if I think about it, and I don't try to think about it, and I think the main important thing is just write every article like you would to your mother who doesn't know anything about investing. That's still how I try to approach everything.
Hmm. That's really interesting. So what is it that 1 year in you were doing? You were working your job, doing this on the side, not charging, not generating any, obviously, sales. What was it that gave you the confidence to quit your job and move forward with this venture, which still was not yet
Hmm.
um, giving you a living?
Yeah, a few things. First and foremost, I always wanted to work for myself. So if my close family didn't kept me from doing it, I probably would have started on myself right from the start, right after university. I don't think that would be a good idea to have done in hindsight. So I'm happy that I got the experience in the industry for a few years. And then there are two other main reasons. First one is right now I'm 28. I will turn 29 in a few months. So 2 years ago I was 27, meaning I had nothing to lose to start by myself. I didn't have a huge mortgage. I didn't have any kids yet. So the worst that could happen is that you go and work for yourself, your business doesn't succeed, and 6 months later or 1 year later, you need to find a job again, and maybe you didn't make that much money over those 6 or 12 months, but that isn't a big issue. And the second point, I was probably quite conservative, meaning I only quit my job when I knew that I make at least twice as much from putting advertisements in the newsletter compared to what I was making with my regular job. And I think that's also from a business perspective something that you don't want to do. You don't want to put advertisements on your website. I don't think that makes a lot of sense. Why? Those people, they subscribe to the newsletter and they subscribe to you because they want to read something about you and your newsletter. So it makes way more sense to sell or promote your own product compared to doing an advertisement where you push people who came for you to someone else's products. So I
Hmm.
never did many advertisements, and so I quit in August 2023, and then in October 2023, I did a full newsletter where people indeed pay a fee per year, and then they can read everything you write, so they can see the portfolio, the investment cases. There is a community and things like that.
So, so you weren't, just to be clear, because I you mentioned ads. Your newsletter is a subscription based, and it was never ad based. Is that correct?
Yeah, exactly. It was never ad based. I'm not going to say that I never put an advertisement on the newsletter. Very, very seldom. So it's subscription based. That's correct.
Okay. And how? So I obviously you mentioned now Capital Alliance, as you probably know, is a community for professional investors, and that would be investment managers, asset managers, allocators, the ecosystem around us, and even publishers and such. So I appreciate you sharing some of that journey because it's very interesting and relevant to others who might be building a business in and around our space. So going back though, I mean, obviously you said I gave away a lot of value, but were there any other specific techniques or platforms or things that you found worked really well? I know that from my perspective, I heard about it multiple years ago, probably not too much after you started it. I think I used to see, particularly on LinkedIn, was a big way that I would see your publishings. Uh, and what platform did you choose, and how did you go about building an audience?
Yeah, sure. I think in general there have been a few tipping points. For example, when Bill Ackman retweeted something, then overnight in the beginning your subscription count it doubles, so that has a lot of value. How everything evolved for me is I start on Twitter just for fun, like to be able to say what I want to say whenever I want to say it. And I initially thought, well, it would be really, really cool if one day I could just reach 10,000 followers on Twitter and just share my opinion. And I think today we are almost at that or 500,000. So that's the power of social media, and it can go really fast. So the Bill Ackman retweeted with that. Jeff Bezos is following compounding quality. Those kind of things all help. In the beginning, it was about tweeting a lot and very general things as well, like quotes from Warren Buffett, from Charlie Munger, some visuals and so on. And then Musk, there were some rumors back then that Musk would or might take over Twitter or X, and you could notice that every time Musk made a small tweak to Twitter, there was a huge effect in the positive or the negative sense, and it was an eye opener for me. Meaning, in this space, and maybe it's interesting after in a few moments to talk about the difference or what I think the difference is between newsletters and funds as well. But in this space, in the newsletter world, you want to own your audience. When you have 500,000 followers on X and tomorrow Musk decides to delete your account or suspend you, you are just gone. And when you have your own website with your own subscribers, those are yours, and you can decide what you want to do with them. That's how you evolved from just doing Twitter or X and having a newsletter for me via Substack and try to gather email addresses. And nowadays, well, I think for the business perspective, for someone who want to do something similar, Twitter is very difficult, very tricky. LinkedIn is still working quite well. So posting a lot of on LinkedIn definitely helps, as you mentioned. Um, well, as mentioned in the beginning, I'm based in Belgium. So what I also notice in Belgium, I have a once every 2 weeks I have a column in the largest newspaper in Belgium. Sometimes I do some TV appearances or talk shows. Those help tremendously for your value, and it's also about brand recognition because it's very. I think it's completely wrong, but a lot of people think, look, I've seen for example, I've seen you Ken on the TVs, so you must be good and you must be very reliable. A lot of people think that way. It's wrong, of course, but
Hmm.
it happens often in that way. In the end, it's also about building a lot of credibility. Last year, together with a friend, I also published a book, The Art of Quality Investing. I'm also working on a new book right now. A book is a lot of work. I wouldn't recommend it to anyone who wants to do it to earn money from writing a book. But once again, it's about building your brand, your name recognition, and doing it that way. And that's so important because you're talking about money, you're talking about investing, and trust and being authentic and being yourself is probably everything.
Hmm. Yeah, that completely makes sense. So going back to the platforms, I think what I heard you say is today Twitter or X is harder to build an audience than when you did it, and that was only a few years ago. But LinkedIn maybe is still an opportunity. Can you talk about the differences between these different platforms and why it's gotten harder from your perspective on X and why you think there's still an opportunity on LinkedIn? And then I'd love to talk a little bit more about the specifics of each platform and what kinds of things you've learned about them.
Yeah, sure. So Twitter, I think that the answer in very short there is, well, Elon Musk took over Twitter and he doesn't like it. What you try to do as a newsletter newsletter writer, what you try to do as an entrepreneur, as a business person, is you try to provide value, get people to follow you. Maybe the next step after they follow you is get them to your website and hopefully subscribe to your website. But Musk doesn't like it when you try to drive people from Twitter, from his platform, to your website or to some external website. So you see that it's pushed down a lot. And now it seems like it's very unpredictable. When I put a lot of time and effort to explain, for example, let's just say, name something, return on incremental invested capital, I knew before the Musk era that when I put a lot of effort into it and it was written well and so on, that it will probably reach between 500,000 and 2.5 million people. And when I would do something similar today, it could be the case that it only gets 10,000 views. So it's very volatile and it isn't trustable anymore. And I hear that from a lot of people that it's very hard to build an audience of
And
right now.
is that if you include a link to an external resource or just the
In
nature of what changed? Okay.
Sometimes you see people who write something excellent, they get 3 million views and 10,000 likes, but it only gets them 20, 30 followers to their Twitter account, which is strange.
Hmm.
Anyway, and then I put a lot of time or more time on LinkedIn right now. Why is
Hmm.
there some untapped potential in LinkedIn? It's probably easy if people are listening to this. Well, same bit of situation with my former job. If you work for JP Morgan, just saying something, you can't just share whatever you want on LinkedIn, for example. You can't just talk about investments because the rules usually are very strict. But
Hmm.
in the case if you have your own business or if your newsletter, well, for example, people like myself, we are able and we are allowed to share investment wisdom or something investment related on LinkedIn. So there are a lot of people on LinkedIn who are interested in investing, but there are not a lot of people who are allowed to talk about something investment related. So the people who actually do post about it, well, that has a lot of upside potential and can catch a lot of eyeballs.
Um, so I think one of the things that I noticed about your posts was you would give away, letters or different reports or things like that. So like kind of here's a bunch of free information that I've compiled. I think that was one of the things I noticed, which stood out at me. So just more broadly, like if you were building an asset management firm like I am, or um, building another newsletter or just building some other type of business. Um, what insights that have you learned about LinkedIn uh, and or Twitter or any other social media platform that would be helpful to someone who isn't as experienced as you are with how to build an audience and how to build a brand recognition and how to build customers potentially using the power of social media?
It's a good question. It's a difficult question, and that's also the case, by the way, if you compare a newsletter with a fund, and that's one of the reasons why I'm not looking anymore into launching a fund myself in the short term. The regulation is so strict for a fund, and compared to a newsletter, the difference is almost ridiculous. I'm still looking, and I might launch a fund, but via a third party and via an external party in the future. But let's see. But so for LinkedIn, I think there are a few important things. First and foremost, it's about being very authentic, being yourself. People should notice your voice. And a fun story I can tell there as well is initially I started on Twitter. That went quite well. And then I had a similar thought. Look, I think at least I know how Twitter works. So now let's move to LinkedIn and try to do the same because I have a lot of data. Each month I compiled every tweet I ever did and I analyzed them. Look, this is so popular, this is not so popular, and so on. So I had all the data and I thought if I just take all the popular things for Twitter and do it on LinkedIn, that should work well, right? And I tried and it didn't work. So it didn't work. So tried it for 2 weeks and basically gave up. And then I got in touch with someone called Nicolas Boucher. He's more in financial planning and analysis. I think today he has 1.1 million in followers on LinkedIn. And he said to me, well, I want to start on Twitter. You want to start on LinkedIn. Let's just help each other. You teach me everything you know or you think you know about Twitter, and I same about LinkedIn. And we did that, and that really changed it for me. And it's very difficult to explain, but sometimes some very small tweaks, some very small adjustments can make a very large difference. So, for example, I did a LinkedIn post on myself and then got something like 10 likes. Then Nicolas gave his advice. I did more or less the same post with a small tweak, and it got 5,000 likes and 3 million views. But I think for LinkedIn in general, what's the most important thing is the visual you add to it, or add a certain image. I also work with a designer from India who, for example, look, I want to write about return on incremental invested capital. This is my article. This is my text. Can you compile the entire article in one visual that is looks beautiful visually, and then you explain to a kid as simple as possible what return on incremental invested capital is, for example. Things like that work well, and then it's just every LinkedIn post probably is some kind of mini article. So the most important thing is the visual. The second most important thing is the first sentence you write. And the goal of the first sentence is to hopefully let people read the second sentence. The goal of the second sentence is to read the third sentence, meaning your first three sentences are also very, very important. So what I usually do is the first sentence of a post is some kind of title. Second sentence is usually some kind of hook you use, or what am I going to share? Why is this valuable to you? And then you start to do your actual post, and hopefully start to provide value there. And the great thing about social media in general, I would say, is in Belgium, we use a saying often, well, you throw a lot of spaghetti to the wall and see what sticks. I'm not sure whether that's common in the US and whether you know what I
Hmm?
mean by that. But it's
Yes,
just,
yes, we do. Yeah.
you can test out a lot of different ideas.
We
Test
use a different word than spaghetti, but yes,
which one do you use, just out of
mm,
curiosity?
it's a much more degenerate one.
Okay, I won't bother asking it that way. But
Yeah.
you can test out a lot of different things, see what works, and if it works, just bet heavily on that. It's like what
Mm.
nuggets. If the odds are in your favor, bet heavily, and do that with social media, because it doesn't cost a lot of time to test out a lot of things and try it in 20 different ways, and then just analyze it, see what works best, and just replicate what's working.
Hmm.
So Monish Prabhai said that, I'm ashamed to stop. I completely agree with him on a business level, or this level as well. You just look at what's working. You can look, for example, at what other popular accounts are doing on LinkedIn. Vatsal, you are also very popular on LinkedIn. Just look at what those people are doing and try to replicate it in your own style. For example, look at an account that's very popular about productivity and HR and stuff like that, and try to replicate his or her strategy into the investment field. If you execute well on it, it will probably work too.
Hmm. No, those are some very good insights. So uh, now we're like, given that you've already got a huge audience in, I guess, both LinkedIn and still Twitter as well.
Hmm.
Uh, I would think that, I mean, most people think like your audience is a key asset. So if you have a big audience, I'm surprised to hear that even with a large audience, if you post on X, that you don't necessarily always get the views that
Hmm.
you would want. Because I think a lot of people that don't have big audiences, myself included, we we dream about having a bigger audience, 10,000 followers or whatever. So I guess it's not necessarily automatic that even with a large audience, the views will follow.
Yeah, exactly. I think that's a very important thing to know about social media. Things change all the time, and maybe today LinkedIn and Twitter are relevant, and in 10 years from now, something completely different will be relevant. And that's exactly also why you want to own your audience. To be honest about that, I don't care too much about followers on LinkedIn or Twitter. What I care about is how many people are subscribed to the emails and receive all the investment cases every single week, and that's the most important thing. So, for example, let's say in an ideal world, that one day via the third party provider, I would launch a fund. Well, I think social media, like I have more or less 1 million followers on social media, but to be honest, I don't think it will even be important. The newsletter will be important, and the website will be important, and having the emails there and people would trust you. That's the most valuable asset you have. And you see that a
Hmm.
lot actually of people who are doing something similar than I have. Traditionally, they have built their audience via Twitter. And you have a lot of those people who are still quite successful today. We completely abandoned Twitter, left Twitter, or don't bother doing a lot of effort there anymore. So the algorithms are changing very rapidly. You need to own your audience. I think that's the most
Hmm.
important.
And the way you do that is by capturing their email and
Yeah,
engaging in a direct communication with them through email or
exactly.
text. Okay,
Exactly.
got it. What system do you use? What platform? Just Substack? And why did you pick Substack?
Yeah, start with Substack initially. Um, because it's easy. I was still working in the industry. It's easy. You can set up a Substack in a few minutes.
Hmm.
Everything is taken care of for you, and you just need to do the writing, and send it out. And how the platform works is very, intuitive. So I'm still on Substack there, and it's also Substack on itself can also be seen as a kind of social media platform. Meaning there's some kind of leaderboard. Look, those are the most successful Substacks in finance and investing, for example. And what happens is once you get more higher in the leaderboard, Substack also notice that, and they start, okay, wisdom of crowds probably. If this guy is the number one in finance and investing, he's probably quite telling some interesting stuff. So we need to push, or we need to recommend other people on Substack that are interested in investing to read him or her. So that's I think the key win right now. You probably get around 30, 40 to 50,000 emails a year just via the Substack platform.
Mm.
So
Hmm.
that's what happens. On the other hand, how the fundamentals of the business also work, and that's also the fun thing. And I don't want to make you jealous, Ken, but that's the fundamental difference with fund and newsletter. The only thing I need is my laptop. I have a subscription on the Refinitiv, but that's it. And for the rest, I have no um, research reports. I don't have JP Morgan. I don't have Morgan Stanley, Morgan Stanley
Hmm.
on purpose. And I use FinChat or Fiscal AI a lot to have all the data regarding stocks I own and so on. But that means the margins of such a business are very high, and it's very
Hmm.
scalable. So the fundamentals, that's the pity of Substack. You pay 10% in fees to Substack,
Hmm.
and 2.9% fees to Stripe, which is a payment platform for people
Hmm.
to enter their credit card information.
Hmm.
But that's about it in general.
So you've stayed with Substack even though as you grow your newsletter, the fees obviously are
My
substantial.
my rationale has always been, well, I pay 10% of my revenue to Substack.
Hmm.
But when Substack drives at least 10% of the business due to the recommendation feature, like
Right. They're
30,000
amplifying.
emails a year, then it's worth paying that amount to them. So, and it's very,
Absolutely.
I don't have any, I hear people and some other people who have their own website and so on. It's quite expensive as well. It's a lot of, you need to put a lot of effort in it. You need to hire an IT guy or a woman and so on. And now everything is done for you. So you just need to focus on the writing and your investment cases, and that's it. And that was also what initially brought me into Substack.
Now, you mentioned some other softwares that you use. I'm not familiar with them. Refinitiv. There was some AI one.
Yeah, so fiscal AI is something I use. It's like, I would say it's a Bloomberg terminal for retail. That's how I like to compare it. So it's the
Okay.
same. If you have a company, just naming something, let's say Berkshire Hathaway, as we met there,
Uh-huh.
and you just enter Berkshire Hathaway and you get all the financials. You can read the earnings call transcripts and things like that. So it's a Bloomberg for retail, and Bloomberg is probably the only thing I miss from my institutional investment days. To be
Hmm.
honest. Um, and that's also, well, thanks to AI, thanks to the internet, all those data, all this information, well, it's becoming more and more available, and it's becoming more and more maybe a commodity to some extent. So
Hmm.
it's also the great thing there. So it's something I like to use and probably use every day. Yeah.
It's called Fiscal AI.
Yeah, exactly. They
Okay.
recently changed their name. So initially it was FinChat AI, and now it's
Oh.
Fiscal AI. And it's also a funny story, by the way. I met Braden Dennis, the founder of FinChat or Fiscal AI, also in Omaha. So the first time I went 3 years ago, and Clay Fink, the host from the Investors podcast, he
Hmm.
asked to have some dinner on when I just arrived. He said, "Well, some friends will come by," and Braden Dennis was there, and that's how also how we met and how we set up a structural partnership. So
Hmm.
from maybe from people listening, initially I might also always been too frugal to go to Omaha because it's a long trip, it's an expensive trip. I rather invested 2 3 thousand I spent on going to Omaha than, or I rather invest 2 to 3K over going to Omaha and see Warren Buffett. But in the end, it probably has been one of the best investments
Hmm.
you can imagine. So highly recommend to everyone on going.
Yeah, that's actually kind of like a good, maybe not that this is the purpose of the podcast, but we're building the Capital Alliance community, which meets 3 times a year, and we're very much in the early stages of building the community. But one of the core reasons that we're building a community where we meet in person as professional investors to help each other and to grow together is that at least I believe it's been my experience that you could do any endless amount of emails or Zooms or whatever, but the
Mhm.
quality of being together in person is very difficult to replicate any other way. And then the serendipity that happens, like obviously we didn't go to Omaha thinking, oh, let's meet Peter and let's do a podcast with Peter. That was not anything on my radar screen, but it happened as a result of us meeting and being together physically in Omaha. And many other things have happened as a result too. And so part of the magic of a community where you meet, because you're all interested in something kind of similar, but you're there together in person. And obviously, in the case of our community, we're coming together specifically to be with each other in a spirit of giving and a spirit of helping each other. And I see that that theme has kind of already come. You've mentioned it a few different times with the gentleman who was good on LinkedIn and you were good on Twitter, and you guys helped each other. And now you're mentioning it again in terms of this partnership with the AI,
Yeah, Fiscal AI.
FinChat, Fiscal AI, which used to be FinChat. So can you talk a little bit about how chance meetings or cooperation with others has impacted you?
Yeah, sure.
And
hmm Yeah, so probably I really couldn't agree more on your statement, and I've thought about it for myself for a long time. I think if you would have said to me 2 years ago or compounding qualities today, I would have just said you're completely crazy. But I think that there are two very important things, the two most important things. First thing is just read as much as you possibly can, like Charlie Munger, be a book with legs sticking out. And I've set myself the goal: look, I want to read 52 books a year for the next 52 years. And hopefully, when you do that, you can't help but become very wise. So just read and read biographies, read business books, read books about investing, read everything of Warren Buffett. You can just pick the mind of the best person in a certain field for 20, 30 USD, which is ridiculous. So reading helps a lot. And on the other hand, indeed, it's having the great people around you. Your network is your net worth. It's a cliche, right? But it's exactly true. And when you have the opportunity, like the Capital Alliance community, when you have the opportunity to know people that are doing something similar than you, but maybe are 3 4 or 5 years in advance of you, well, that's the best gift, and they are happy to help you and share advice with you. That's the best gift you can possibly have. And I have some people also in my inner field with whom I talk daily, and they are farther than me in this journey. And it's hard to obviously it's very hard to estimate what the impact has been so far, but I'm 100% sure that those people have, on the one hand, saved me hundreds of thousands of dollars in costly mistakes, and on the other hand, probably also have gained me hundreds of thousands thanks to making the right decision. And I'm quite sure that some of those people are getting annoyed of me because for every somewhat important decision I need to make, I reach out to 4 or 5 people who I see very highly or think very highly of, and ask their advice. So I think what you are doing with Capital Alliance, well, that's something very similar, right? And those are maybe when you meet someone first time, you don't see something directly or what could come out of it, and maybe in 90% of the times, nothing comes out of it. But you will meet some people where you can maybe do a structural partnership with, do a launch a business with, ping pong about ideas, and that's so valuable, and that's probably priceless.
Hi there, Ken here. Thanks for watching the Capital Alliance podcast. If you are the founder of or a partner in a professional investment firm managing $50 million or more with the objective to grow your firm and grow your team, then I want to tell you about the Capital Alliance, which is the sponsor of this podcast. The Capital Alliance is a special invitation-only community for founders and partners of growing investment firms where we get together multiple times a year in person. So if that's you, check out the link below. Now let's get back to the podcast. Thank you. Yeah, that's definitely been my experience because talking about, about cloning, I didn't actually come up with the model for Capital Alliance. I cloned it from another group that's very successful, just not in our vertical, not in investments or professional investing. It's in a totally different domain, but I have an interface with that domain. So I ended up joining that group 8 years ago. It had all these benefits for me, and then I just said like, hey, this is such a successful, wonderful community. If I had one in the thing that I actually spend most of my time on, how great would that be? And so that was the genesis of Capital Alliance. Um, Now you also mentioned the power of serendipity. How have you found, how do you create serendipity, like when you're starting out, like and actually, I mean, related to Capital Alliance before I get there, so one of the challenges when you're doing something new is people don't understand, the value, so it's hard to overcome that initial skepticism. And for example, you mentioned Omaha, how you said, hey, it's not worth $3,000 to fly all the way, I could use that $3,000 for something else. um, but as it turned out, when you made the investment, you realized, oh, it was more than worth it. I got a huge ROI on it. And it's something similar with anything new when you're trying to explain it to people. It's true with our community. So how do you think about that reluctance to invest in something when you're not sure if it will give you an ROI?
Yeah, sure. I think Bill Gates said that, but I completely agree, and I also agree for myself. Probably 80 to 90% of what happens to you is luck, and then 10% is skill. But also, you need to generate or try to generate your own luck to some extent. And I think just two important things that you need to have in anything is one, you need to be passionate about something, passionate about what you do. And the second point is you need to be curious about everything and explore, because the first point, when you need to be passionate, well, we all know this. And then when you have your own business or in life, everyone will face tough times, and maybe very tough times during your entire lifetime. Same in your business, but when you're passionate about it, when you love investing, when you love what you're doing, you are just willing to do things that other people are not willing to do. When I think back about when I launched Compounding Quality, I was working 60 hours for my regular job and around 30 hours for Compounding Quality a week. You don't do that when you love what you are doing, and you don't do that when you think, oh, I'm going to work 52 weeks, 30 hours, or 1,500 hours on Compounding Quality, and I'm going to make so much money with it. That isn't the case at all. You just do it because you're having fun, because you love what you are doing, and because you're having fun. So I think that's very important, and just being very curious about everything, explore everything, keep learning about many different aspects. That's so important. And it's like a podcast is a great example. For example, if I look at, sometimes I do a podcast and it doesn't move the needle at all, and then another podcast where you notice a huge effect. So sometimes you just never know in life. But it's once again to throw the spaghetti to the wall thing. You need to try a lot of things, see what works, bet heavily on what works, and invest heavily in what works. But there are always very unexpected things that happen. So, for example, also, well, right now I'm looking into or sparring with a company to potentially work together with an existing asset manager and have not being involved operationally, but let them run some kind of compounding quality fund. Well, did I met that person? Well, we both needed to talk at the same event 3 years ago. So you never
Hmm.
imagine things like that. But I think you just need to be open and ready. Think a lot of out of the box, because every problem has a new solution, especially when you are where you think creatively and things like that. So I think that's the most important thing in general.
Yeah, it's an interesting balance between sort of focus and being open.
Hmm.
But yeah, that's sort of a great way to express it. That I think a lot of times people who are open to things, they stumble onto luck.
Hmm.
And I find some people are not as open. They want to see the exact logical reason that they get a high ROI on every decision they make. And I think in the value investing community, for example, probably there's a little bit more skew that way. So it's kind of interesting, but at the same time, you know, like you kind of make your own luck. So um, it's an interesting dichotomy.
Hmm.
Let Vatsal ask a few questions here. Vatsal, do you have anything for Peter?
Yeah, Peter. I had some questions. I think what was very interesting, and I'd want to dive a little deep on is, in the first year when you started compounding quality, right? It was free. When you were monetizing it, or the first month or few months of monetization, what was that like? What was that big shift in your brain when you realized, okay, people are willing to pay like hundreds or thousands of dollars for your content? What was that feeling like? So I want to go deeper into, like, the initial part of you scaling up compounding quality and monetizing it. What was that journey like?
Yeah, it's an interesting question, and I still recall everything needed to go very quickly. So I didn't want to set up a business before my contract with my former employer expired. And then I had 1 week to set up the business, have a business credit card, have a business bank card, and so on. And the official launch was on the 31st of August 2023. And I opened the doors and I was so stressed. And what happened that day is, because I launched the business only 2 days earlier, and my bank card was valid for 13 hours, something like that. Well, I live in Belgium, so I had a Belgian bank card. The information wasn't processed to the US yet. So people in the US, Visa, MasterCard, and so on, they didn't recognize the credit card yet, and I thought it was fraudulent. So everyone would try to take a subscription on day one living in North America. They got declined, which was a very stressful situation. And I still noticed, well, I sent out the launch email. I was sitting in front of my computer, but I just couldn't handle it anymore. And I just went for a run afterwards, and I probably broke my record on the 5K run because I wanted to be back as soon as possible to still check whether someone was interested in it or not. I think in general, it's a great learning experience. Like I said, during the first few months, probably also there was way more interest than I initially thought, and everything is going or kept going quite gradually for that. And to give some insights about the newsletter business economics, but it's getting harder and harder. The space is getting more and more competitive nowadays. But in general, you try to get people from social media to your website, and you gather the email address. For me, I write 3 articles a week. One is very general and it's completely free, and then two are behind the paywall. So people pay $4.99 a year to read everything. So a lot of people subscribe on the free list, and then more or less, I think nowadays it's a great target to that 1 to 1.5% of all the people will read you convert to a paid subscription afterwards. So that's a bit the fundamentals or the mathematics of the newsletter business. And one thing that I really underestimated in the beginning is people initially they probably subscribe to you for the investment cases, for learning and what you have to say and so on. But people stay for you for the community, like Capital Alliance, for the community, and because they in some way like you and they want to follow your journey. So also the personal aspect is something that I truly underestimated. People come to you for the investment cases, but they stayed to you or with you for the community. That's a clear lesson that I also learned over the past few months and years, probably.
Yeah, that's, I think that, I'm so glad you said that, because that, was going to be my next question, which is, there are, like, many investing newsletters out there. And of course, you're amongst the most successful, right? So what do you do to keep it differentiated compared to other newsletters, and how do you engage with your readers and your community? So tell us a little bit about that aspect of, building compounding quality.
Yeah, so the space is becoming more and more competitive nowadays. Nowadays, it's also very easy to launch a newsletter, which is one reason. And on the other hand, AI is also improving and improving and improving. And what's crazy is, for example, I always use the same 15 points to analyze a stock. When you ask ChatGPT, well, look at just naming something Visa and use the 15 point analysis framework of compounding quality, it does quite a good job already, which is quite scary. So data, investment data, are becoming a commodity. Who knows, one day investment cases will be there too, to some extent. So I think two things are very important. Well, just your being yourself, your authenticity, that's so important, and you can't underestimate that. Like I mentioned, people follow you because they like your journey and they want to see that. And the second point is community as well. So you need to, yeah. And I always call every subscriber of Compounding Quality a partner, for example, because just to mention to highlight that we are in this together. And you have in finance a lot of investment funds, very expensive ones and so on. But what I also always say, every single dollar or euro I have invested in the companies I write about. And this obviously by definition doesn't mean that every investment you make will be a great one. And by 100% sure that that won't be the case. But what it does mean is that when I write about something and it turns out to be a horrible investment, I will be the first one to have the negative consequences as well, because I'm fully invested in those companies. So something like that is very important. And also linking to the beginning of the podcast here, as a kid I always wanted to become a teacher. So combining the teaching aspect with the investment aspect, I'm having living the dream and combining my two passions right now. So I think the skill, and I noticed that in the asset management industry as well, you have a lot of very, 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 very smart people there, way smarter than I am. But some of them are not able to explain certain concepts in a very easy, digestible way that your mom or your 14-year-old sister can understand it. So trying to do that and trying to explain very complex items in a very easy way, that's also something that's important, I think.
100%, 100%. I think the last question from my end would be, I think, you mentioned about AI, right? So how are you using AI, or what is the impact that AI has had on compounding quality, right? Because as you said, it's very easy to like do write-ups or like analyze data, and especially with deep research and these AI models like getting better, right? So what has that been like for you?
Yeah, we are as old, so we are both 28, Vatsal, but I'm probably a very old school guy in the sense that I do use AI, but I don't use it that much. So I don't use it for to write investment cases or anything like that, because I don't trust the data, or don't trust the data, not yet. What I use it for is sometimes when you wrote something, this doesn't, yeah, this isn't written too smoothly. How can I improve this? Well, how can I do this? Look, I've written this article. Can you propose me 10 potential titles for this article, or I'm thinking about those two ideas. Which one do you think I should work on first? Those kind of things I use it for. I'm not really using it for data or information yet, but AI obviously will only become better in the years ahead. So I think that's also a great thing. And I mentioned that by the beginning of answering this question. I'm an old school guy and I don't use it that much. But it's also a tricky thing because as an investor as well as entrepreneurs, you need to keep evolving and need to stay on top of your game and need to encourage or look into all the new ideas and new things that happen. Because when you, for example, as an investor, hopefully in 20 years from now, your investment philosophy isn't exactly the same as 20 years ago, as today. Um, if you, for example, would be still using the net strategy of Benjamin Graham, well, and just buying very cheap companies on the price to book and so on, it's also a strategy that's facing a hard time. So we always need to keep evolving and keep learning and stay open to new ideas and what's happening in the markets and in our society and so on. That's probably also a very important thing for me as well.
Awesome, awesome. Yep, Ken, those were the questions.
Yeah. So what I'd love to just end on is where do you see investing going in in the in the intermediate to longer term? We can talk about it from a bottoms up or just what's going on in the world. Obviously, things are always going on in the world. The principles that I think you follow and I follow I consider them to be timeless. But there are things that are different every time. So I'd love to get your thoughts on what you see for investors and investing staying the same or changing in the years ahead, especially now with the rise of AI and technology. It's possible that some of those things could actually, in fact, change things that have been true for 100 years or more.
Yeah, I would say or would see two things. Is one, and personally, and that's not what you want to say, but what I think is personally, I think the next decade for investors will be not as good as the past decade for investors, just because if you look at what drives stocks prices, underlyingly, it's mainly driven by economic growth. And economic growth is driven by two factors: well, productivity growth and the growth of the working population. We know that the growth of working population is decreasing in almost all countries. So all the growth over the next decade needs to come from productivity growth, while over the past decade we had productivity growth plus the growth of the working population. AI will be a very important factor, I think, for productivity growth, and it will help a lot. But that's something that worries me sometimes, or I would not be surprised if, for example, right now the S&P has done phenomenally well, and maybe people are calculating 7 to 9% average return per year. I would not be surprised if, for example, it would be a bit lower, 5 to 6% in the next decade, something like that. And on the other hand, one book I love is Where the Money Is, from Adam Cecil, who said, well, there are three value routes. So you have value 1.0, which is more like Benjamin Graham. That's more buying cheap companies based on the price to book and so on. You have value 2.0. That's more the quality investing. Vatsal is showing the book, so here we are. So value 2.0 is the quality investing direction. And then you have value 3.0, which is the statement, look, you have a lot of companies, mainly tech companies, we're investing a lot in all those intangible assets and making a lot of investments to build their moat, but it isn't fully shown in their balance sheet yet. It isn't fully shown in their income statement yet, in their cash flows, but we should take that into account as an investor. Well, personally, I'm probably more in the value 2.0 camp, but I like his idea. And for me, that's also just a reminder, look, this is your investment strategy right now, but you need to keep learning, stay open, remain flexible, because who knows what the world looks like in 30 years from now. And maybe the strategy you use right now that is working quite well, maybe that's the Benjamin Graham value investing of today's world. So just keeping that in the back of your mind is really important for me personally.
Yeah, actually, on those 2 points, I'm a big believer that so if you look at the long-term chart of human productivity, for 1800 years, it was basically like flat. And then with the Industrial Revolution, it started going vertical. And it may be that this next stage of AI, of artificial intelligence, might actually be the most incredible jump in productivity that we've ever seen. Because I think at one level, productivity was limited by human intelligence and human ability. And now, if intelligence becomes much cheaper and super intelligence becomes ubiquitous, then that probably limits a constraint on productivity that is potentially very fundamental. And then on the second point related to that uh, thesis, I just saw a speaker who made a very interesting point, which is he said, "Hey, we had these tech companies that were actually outstanding businesses from a capital light perspective, but now they're all spending hundreds and hundreds of millions of dollars, billions of dollars in AI chips and hardware, things that obsolete probably much quicker." And so he's sort of saying that potentially these great businesses have become more mediocre businesses, uh, and that shift in the market will be profound, and that will drive capital away from what's worked in the last 10 years, to your point, to maybe areas that have been less favored, and that would include certain international markets that are out of favor, certain sectors of the market, such as smaller companies and value companies that have been out of favor. And of course, private equity, the move of big institutions to private equity is probably reversing now because of illiquidity and because so many of them crowded into that one sector. Uh, and that might also be positive for smaller companies and potentially value companies as well. So I have to say that in my more than 30 years of being active in investments, it's always been interesting.
Can imagine, and let's hope that AI will be the biggest productivity increase in the world, right? Because the numbers add up when you think about, let's say that the in the very long term, stock markets do a 7% return per year. Well, what's the reason or the underlying reason for that? It's economic growth, which is on average, let's say 3%. You have inflation, which is more or less 2% on average in the very long term. And the average dividend yield, now it's lower because the valuations are high, but the average dividend yield is 2%. So it's 3% economic growth plus 2% inflation plus 2% in dividends or dividend yield. Yeah, that's your 7%. And that's where you get your returns from as an investor. So let's hope that it will continue in the years ahead.
Yeah, the question there though is that obviously like a lot of franchises, like Buffett talks about moats.
Hmm.
A lot of moats depend on uh, some protected, thing. And
Hmm.
so network effects, cost advantages, blah 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 blah, whatever. That there's a list, right? But I guess on the threat side, if the mode depends at least on kind of information asymmetry
Hmm.
or knowledge asymmetry, those modes might collapse. So we'll see what happens on that front.
Yeah, exactly. Never a dull moment in the stock market, probably. And that's the beautiful thing about this job.
That's for sure. Well, Peter, thank you for sharing your insights and being so open on your journey so far. It's been a wonderful conversation, and we really appreciate you taking the time.
Thanks. I appreciate it. So thanks so much. And I'm truly a fan of the Capital Alliance community. So hopefully in the future I can see some people who are listening there right now as well in the community.
That'd
Yeah.
be great.
Yeah. Thank you, Peter.